Okay, guys, we're approaching the end of the painful part now, and the final thing I'm going to talk about in this is non-dilutive finance. And this is really anything that isn't straightforward equity or debt. And what it really means is that there's no balance sheet effect. So it doesn't change the ownership of the company. It's non-dilutive. It doesn't dilute your ownership interest. And also it doesn't create a liability. So it's not money you owe either. So an obvious example for this would be something like a government grant. So let's say when I start this business, the government of the country that I live gives me $500 just for starting this business. So what that's done is it's boosted my pre-tax income by $500, and it's also boosted my tax bill. If I take this out again and you watch the tax line, I originally was going to pay, $48, 20% of 240, but now by adding this grant in, my pre-tax income goes up to 740, so I'm paying the 20% of the incremental 500, so another $100 in tax. Things like business plan competition winnings, most grants tend to be treated in this way. However, there is a possibility that your grant might be considered, tax-free, in which case you'd report it below the line. So, I still would pay tax on my pre-tax income of 240, but I then get this $500 down here, which I don't pay tax on. So it boosts my net income. When I say it doesn't affect the balance sheet, I mean that's not strictly true. It just doesn't affect the liabilities to any degree or the ownership structure. In fact, that extra money goes in my bank account as cash, and it also, I reflect it in the retained profit account. So essentially, it's a $500 addition to my profits carried forward that I can invest next year. These aren't the only types of non-dilutive financing, but the others are really dependent on where you are and the incentives that are around at the time. So, for example, if you're planning on building a factory that's on what's called brownfield land, so land that's already been used for something else, you might find that the government chips in as part of the construction costs. So they might pay for anything that happens underground. So they'll pay to put the utilities in, they'll pay to do the foundations, they'll pay to do the soil remediation. So eventually, essentially they're encouraging you to build on land that's already been used for something else rather than on a greenfield site. Similarly, if your biggest vendor thinks that your business is really worth investing in, they might give you preferential terms. So even though you sell to your customer for cash, so you get the money immediately, your vendor might give you, 3 or 4 months to pay his bill. So essentially you get to use his money for that period. Similarly, you might be a manufacturing company and you need a very expensive piece of machinery to make your thing, and the machinery company might lease you that machine on a month-to-month basis rather than you have to go out and buy it. So, essentially, you might end up paying for that machine over the course of 3 or 4 years, and they might kind of take it back if your business plan doesn't work, etc., etc. And you essentially get to use that machine almost on a rental basis rather than having to buy it. So I don't want to say too much more about that because it's very situational. It's very dependent on where you are, what people what the other people in your ecosystem are encouraging you to do at any given time. But understand that those kind of alternative methods of financing, may be out there when you come to launch your business. Thank you.